Let's talk about the single most important thing you need to know about your money. Seriously, getting this one idea can completely change your financial life. And it all starts with one simple question. So, why is a dollar in your hand right now worth more than that same exact dollar a year from now? I mean, it seems weird, right? A dollar is a dollar. Well, not exactly. And by the time we're done here, you'll know exactly why, and more importantly, how to use that knowledge to your advantage.
Oh, and to make things interesting, I've got a little challenge for you at the very end to see if you've been paying attention, so stick with me.
Okay, so to get to the bottom of our big question, we've got to go back to square one. What even is money? The best way to think about money isn't as wealth itself, but as a piece of technology. It's just a tool we invented to make trading things way, way easier. I mean, think about it. Before money, you had to barter. You'd have to find someone who not only wanted your chickens, but also had the bread you wanted. Money just simplifies all that. And this tool has three basic jobs. First, it's a medium of exchange. You use it to buy a coffee. Easy. Second, it's a store of value, meaning you can save it to buy that coffee tomorrow. And third, it's a unit of account. It tells you that a $50 video game costs more than a $20 t-shirt. But here's the catch. One of those jobs is constantly under attack. And that brings us to the villain of our story, inflation. It's this invisible force that's always trying to sabotage your money's ability to store its value. Nothing shows this better than a simple can of Coke. Back in 2010, $1 gets you one Coke. But fast forward to 2025, and that same dollar only gets you half a Coke. The soda is the same, but the purchasing power of your dollar got chopped in half. That's inflation. So why does this happen? Well, it's pretty basic economics, really. Sometimes you've just got too much money floating around in the economy for the amount of stuff there is to buy. Other times, everyone just wants the same thing and demand outstrips supply. Or it just gets more expensive to make stuff. Wages go up, materials cost more, and companies pass those costs on to us. So if inflation is the thief constantly picking your pocket, how do you fight back? Well, you actually have a secret weapon. And that weapon is time. And this gets us to the heart of it, the answer to our big question, the time value of money. A dollar today is worth more than a dollar tomorrow simply because of its potential. You can put today's dollar to work right now by investing it. A dollar you won't get until next year? It's just sitting on the sidelines. Let's put some numbers on that. Say you have $1,000. If you invest it and get a 10% return, that's an extra $100 in your pocket after just 1 year. But if you wait a year to invest, you miss out on that $100. Poof, gone forever. That's the cost of waiting. Okay, but this is where it gets really, really powerful. The real magic isn't just that your money earns money, it's when your money's earnings start earning their own money. That's the incredible power of compounding. Just look at this table. Year one, your $1,000 earns you $100. Pretty straightforward. But look at year two. You're not just earning interest on your original $1,000 anymore. You're earning out on $1,100. So you get $110. And it just keeps picking up speed. Your interest starts earning its own interest, creating this incredible snowball effect. There's a reason Einstein supposedly called this the eighth wonder of the world. It really is that powerful. When you get it, you can make it work for you. When you don't, you often end up paying it to someone else, usually through things like credit card debt. Let's look at a side-by-side. With simple interest, you earn that same $100 year after year. After 5 years, you've got $1,500. Not bad. But with compounding, you've got over $1,600. And that's without you lifting a finger. That gap just gets wider and wider the longer you wait. So now we've got our two opposing forces, right? We have inflation, the thief, trying to shrink your money's value, and we have compounding, your engine, trying to grow it. The whole game is just making sure your engine runs faster than the thief. And here's how you know if you're winning. It's not enough to just look at your investment return. You have to subtract what inflation took away. So if you make 8% on your investments, but inflation was 4%, your real gain, the actual increase in your purchasing power, is only 4%. You have to beat inflation to actually get ahead. And what happens if you don't? What if you just let your money sit in cash? Well, this number is just brutal. If you had $10,000 in cash after 10 years of pretty average inflation, it would lose almost 30% of its buying power. You'd still have $10,000, sure, but it would only buy what about $7,000 used to. That's the price of doing nothing. Okay, let's wrap this all up. Here's what you need to remember. 1. Money is a tool. Put it to work. 2. Inflation is always there, quietly trying to make you poorer. 3. A dollar today is worth more than a dollar tomorrow, which means the best time to start investing was yesterday. The second best time is now. And 4. Compounding is your superpower for building real long-term wealth.
All right, you made it. You now know the most important rule of money. So about that challenge I promised, it's time to put what you've learned into practice.
Here it is. If your investments are earning you 7% a year, but inflation is humming along at 3%, how many years will it take for your real purchasing power to double? Remember, you've got to find your real gain first. I've given you a hint on the screen. Do the math and drop your answer in the comments below. Thanks for watching.